Every week, the financial headlines are full of noise. GDP figures, inflation readings, Federal Reserve decisions, unemployment data, trade balance reports, consumer confidence surveys. Most investors either ignore all of it entirely, which is largely the right instinct, or they react to every headline by making portfolio changes they almost always regret. There is a better approach. Understanding the relationship between the economy and the stock market well enough to know what actually matters for your portfolio, what is noise, and what is signal, without being consumed by it. This is week 17 of the Algorithm Investor. Today we are covering the stock market and the economy, how the key macroeconomic forces work, how they affect your investments, and exactly how to think about economic headlines without letting them drive emotional decisions. Let us start with the most important thing most investors get wrong about this relationship. The stock market is not the economy. These are two different things that move together over long periods, but diverge significantly in the short term. The economy measures current activity, what is being produced, consumed, and employed right now. The stock market prices future expectations, what investors collectively believe will be produced, consumed, and earned in the future. This is why the stock market can rise during a recession and fall during a boom. In 2020, the U.S. economy contracted sharply, the worst quarterly GDP decline in modern history, while the stock market bottomed in March and then rose 47% by year-end. The economy was in crisis. The market was already pricing in the recovery. Similarly, markets often fall when economic data looks strong. If that strong data suggests the Federal Reserve will raise interest rates to cool growth, investors sell ahead of the tightening. The market is always looking 6 to 12 months ahead of where the economy currently sits. Understanding this forward-looking nature of markets is the single most important conceptual shift for any investor who wants to think clearly about economic news. Now let us walk through the 5 macroeconomic forces that have the most direct and proven relationship with stock market performance. Force 1. Interest rates. The Federal Reserve sets the benchmark interest rate, the federal funds rate, which influences borrowing costs across the entire economy. When the Fed raises rates, borrowing becomes more expensive, economic activity slows, and stock valuations typically compress. When the Fed cuts rates, borrowing becomes cheaper, economic activity accelerates, and stocks typically rise. The mechanism is straightforward. Higher rates mean investors can earn more from safe assets like government bonds. This reduces the relative attractiveness of stocks, which carry more risk. The discount rate used in valuation models rises, making future earnings worth less in today's dollars. Both effects push stock prices lower. Lower rates do the opposite. Safe assets yield less, stocks become more attractive by comparison, and future earnings are discounted at lower rates, making them worth more today. This is why the Federal Reserve's interest rate decisions are the single most watched macroeconomic variable for stock market investors. Force 2. Inflation. Moderate inflation, around 2% annually, is considered healthy and is associated with growing economic activity. High inflation is damaging to stocks for several reasons. High inflation erodes purchasing power, which squeezes consumer spending. It forces the Federal Reserve to raise interest rates, triggering the negative effects described above. And it compresses profit margins for companies that cannot raise prices fast enough to offset rising input costs. The inflation and stock market relationship is nuanced. Companies with strong pricing power, the ability to raise prices without losing customers, hold up much better in inflationary environments. Consumer staples, luxury goods, and companies with genuine competitive advantages tend to outperform. Companies with high fixed costs and limited pricing power, airlines, utilities, and regulated markets, tend to underperform. Force 3. GDP growth. Gross domestic product measures the total economic output of a country. Rising GDP generally means more corporate revenues, more employment, more consumer spending, and better conditions for corporate profits. Falling GDP, particularly 2 consecutive quarters of decline, which defines a recession, generally pressures corporate earnings and stock prices. However, as we noted, the market leads GDP rather than following it. By the time a recession is officially declared, which requires 2 quarters of negative data, the stock market has usually already priced in a significant portion of the decline and may even be recovering. Selling when the recession is officially announced has historically been one of the worst possible timing decisions an investor can make. Force 4. Employment. The unemployment rate and weekly jobless claims data provide real-time signals about the health of the labor market. Low unemployment means consumers have income, spending is strong, and corporate revenues hold up. Rising unemployment signals economic stress ahead. The relationship between employment and stocks is also context-dependent. In some environments, particularly when inflation is high, a strong jobs report can actually cause stocks to fall because it suggests the Federal Reserve will keep rates higher for longer to cool what looks like an overheating economy. This apparent paradox confuses many investors who expect good economic news to always be good for stocks. Force 5. Consumer confidence and spending. Consumer spending drives approximately 70% of the U.S. economy. When people feel confident about their jobs and financial futures, they spend. When they feel uncertain, they pull back. Consumer confidence surveys, published monthly, provide a leading indicator of where spending is likely to go. Sharp declines in consumer confidence often precede economic slowdowns. Sharp rises from low levels often precede recoveries. While no single indicator is reliably predictive, consumer confidence trends across 3 to 6 months are worth monitoring. Now the most important question. What should you actually do with all of this information as an investor? The honest answer is, less than you think, and far less than the financial media suggests. Study after study shows that investors who adjust their portfolios based on macroeconomic forecasts consistently underperform those who maintain a steady allocation regardless of economic conditions. The reason is simple. Macroeconomic forecasting is genuinely difficult, even for professional economists with sophisticated models and full-time research teams. The Federal Reserve has repeatedly failed to predict recessions accurately. Wall Street economists have a dismal track record on GDP forecasts. And even when the macroeconomic call is correct, the market's reaction is often the opposite of what logic would predict, because millions of other investors had the same information and already acted on it before you did. What this means practically is that macroeconomic awareness should inform your understanding of risk in your portfolio, not trigger active trading decisions. When interest rates are rising and inflation is elevated, it is reasonable to ensure your portfolio is not over-concentrated in long-duration bonds or highly valued growth stocks that are most sensitive to rate increases. When the yield curve has inverted and leading indicators suggest a recession is approaching, it is reasonable to ensure your emergency fund is fully funded and your equity allocation matches your actual risk tolerance rather than the optimistic version of your risk tolerance. These are structural adjustments made from a position of understanding, not reactive trades made in response to this morning's headline. The framework that works for most long-term investors is elegantly simple. Understand the macro environment well enough to know what risks are elevated. Maintain a diversified portfolio that does not require perfect macroeconomic forecasting to perform well. Keep your costs low and your emotions lower. And let the market do over decades what it has always done. Reflect the long-term growth of the global economy. The investors who consistently outperform over a lifetime are not the ones with the best economic predictions. They are the ones who understand the relationship between the economy and markets clearly enough to avoid the emotional mistakes that economic noise provokes, and who stay invested through the cycles that destroy less disciplined investors. Next week on The Algorithm Investor, we go deeper into one of the most requested topics, the 7 money mistakes that keep ordinary people from building wealth regardless of how much they earn, and the specific fix for every single one. For everything you need to build real wealth, subscribe to The Algorithm Investor. New video every single week. Drop a comment below. When economic headlines come out, do you find yourself wanting to change your portfolio? Yes, no, or it depends. I read every single one. See you next week.